Okay, let's break this down. Our mission today really is taking this, well, pretty dense pile of corporate data. We're talking Garmin's Q3 2025 earnings report, their full year outlook, and turning it into something you can actually use, some real knowledge. Because look, when you've got a company this diversified, fitness, outdoor, aviation, marine, auto OEM, kind of tough
Right.
figuring out which parts are, really pulling the weight and what innovations are driving things.
That's exactly right. Garmin is, well, it's a classic case of using diversification almost like a shield. Our goal here is to quickly look at the health of each of those segments, see which ones are booming, which might be facing some, let's say, comparison headaches, and maybe find a few surprises under the hood.
Yeah, and when you just glance at the top line numbers, the overall picture looks, well, pretty excellent. Garmin had a new Q3 record for consolidated revenue, pulled in almost $1.8 billion.
That's a big jump, up 12% year over year, and it's largely driven, as you said, by double-digit growth in 3 of those 5 segments. Strong stuff.
And that momentum, it wasn't just revenue, was it?
No. Pro forma earnings per share, EPS, came in strong too,
Okay.
$1.99. But what really shows their confidence, I think, is that they didn't just stop at reporting a good Q3.
Exactly. They actually raised the bar for the rest of the year. Let's look at that revised guidance. Full year revenue, they're confirming $7.1 billion, solid. But the real kicker is on the profit side.
Yeah, the full year ETS guidance, they raised it to $8.15 share. That's an increase of 15 cents over their prior guidance. It's a pretty significant signal. Management clearly thinks they can outperform, even with the holiday quarter coming up.
Okay, hold on. If they're raising guidance like that, doesn't that imply things are running super efficiently? Because when you actually look at the margin story, there was a slight dip, wasn't there?
Yeah.
Gross margin down, 90 basis points to 59.1%. So why the squeeze if revenue is so strong?
Yeah, that's a good question. That margin dip, it wasn't really about selling the wrong stuff or a poor sales mix. It was more of a complex mix of global factors. Cost of goods, we saw higher product costs, definitely. The impact of tariffs is still there. And crucially, the strengthening Taiwan dollar, that was a factor.
Oh, okay.
Since a lot of their manufacturing costs are in Taiwan, right? A stronger local currency just makes their products more expensive to produce, basically, when you measure it in US dollars.
Right. That makes sense. Hard to fight currency shifts and tariffs.
Yeah.
But they also seem to be doing something pretty deliberate with inventory. It went up year-over-year, increase to $1.9 billion. Is that just supply chain jitters or something else?
Well, it looks like a proactive move, driven by a couple of strategic things. First, they're stocking up on products they know are in really high demand. Think advanced wearables. And second, it's a hedge against potential geopolitical risks, maybe more tariff increases.
Yeah.
So they're building up that inventory buffer on purpose to kind of cushion against future cost swings. It costs more now short term, but it could stabilize their supply chain later.
That definitely suggests a long-term view. And we should probably highlight the geographic strength, too.
Yeah.
Really shows that diversification strategy paying off. All 3 big regions grew double digits.
Yeah, APAC led the way, up 14%. EMEA right behind at 13%. And the Americas still strong, up 10%. You don't hit record consolidated revenue unless demand is pretty widespread, globally speaking.
Good point. And just to round out the financials, foreign currency, it kind of cut both ways. The Taiwan dollar hurt gross margin, like you said, but overall, currency dynamics actually led to a gain, $20.3 million in Q3.
That's right. It was mainly the U.S. dollar strengthening against the Taiwan dollar on the balance sheet side. So a bit of a mixed bag on FX, but ultimately it ended up being a net positive for the bottom line.
Okay, got it.
Absolutely. So now maybe we pivot to the core consumer business, because this is where things get really interesting. We see the split, 2 big wearable segments, fitness and outdoor, and they're kind of going in opposite directions this quarter.
Okay, let's start with fitness then, because, wow, absolute growth champion right now, 30% jump in revenue, $601 million. What's the single biggest driver there?
It really seems to be the continued push-up market and just the constant rollout of advanced wearables. We're way beyond just step counting now. And look at the margins there, 60% gross, 32% operating. That tells you they're selling premium stuff people really want.
And the new products keep coming. The Edge 550 and 850 cycling computers, those are key for serious cyclists. And the smartwatch line got 2 interesting updates.
Yeah, I've got the Bounce 2 for kids. That's got parental controls, voice calling, messaging, geofencing alerts, which is, huge for parents' peace of mind.
Oh, wait.
And then at the premium end, the Venue 4. All metal design. Looks more like a lifestyle watch. Plus, it has that built-in flashlight. Sometimes it's the simple things, right? Making a premium device feel essential.
But here's maybe the real aha moment, connecting back to that growth, that collaboration they mentioned with King's College London, using wearables to study women's health pregnancy, postpartum, looking for gestational diabetes, hypertension.
This is potentially huge, strategically, I mean.
Yeah.
A partnership like that. It signals they're moving beyond just being a, consumer fitness gadget company. Competition is fierce there. This moves them towards medical necessity, clinical applications. If their tech, their data can be validated for detecting serious health conditions, suddenly you're tapping into the healthcare market, maybe insurance coverage down the line, subsidized devices. That's a whole different ballgame than just selling to runners.
Yeah, absolutely. No wonder they bumped up the full-year growth estimate for fitness significantly to 29%. That's just an incredible trajectory.
Okay, now contrast that with the outdoor segment. Revenue there was actually down 5% to $498 million, even though, interestingly, the margin stayed really strong, 66% gross. But that dip, it needs some context.
Right, it's that comparison problem, isn't it? They had massive launches last year. The diesel watches, the previous Phoenix 8, just set an incredibly high bar to clear. And the new Phoenix 8 Pro, which sounds amazing, it launched kind of late in Q3. Didn't quite fill the gap from last year.
Exactly. That timing is key. But putting the timing aside for a second, the Phoenix 8 Pro itself, that's their big play at the very top end of the market. This thing has satellite and cellular connections, voice, text, live tracking, SOS through the Garmin Response Center. This is serious gear for remote areas.
And the display tech. Let's talk about that. Micro LED. Why is that better brightness and viewability so critical for the outdoor crowd?
Well, think about who uses these. Climbers, ultra athletes, maybe divers, visibility in bright sunlight, or maybe really low light. It's absolutely crucial. Micro LED gives you much better brightness and efficiency compared to, say, OLED or LCD. And what's really interesting, the source material notes, this is the first wearable of its kind with micro LED. So they're really planting a flag there. Premium tech. Competitors now have to catch up.
And speaking of finding niches, they're not just sticking to humans anymore, are they? The Blaze Equine Wellness System, they're putting monitoring tech on horses. How do they even spot these markets?
Yeah, it sounds niche, but it's smart diversification, isn't it? Horse ownership, equestrian sports, it's a huge global thing. And keeping valuable animals healthy and fit, that's critical. So this system helps monitor horse health for riders, trainers. It might seem small, but it shows how they can take their core sensor tech and just apply it to these really specific, often high-margin vertical markets.
Okay, so despite that short-term dip from the tough comparison, the long-term view seems strong. Full-year growth estimate for outdoor lowered a bit to 3%, but they stressed they still expect double-digit growth over multiple product cycles, still aiming to beat the market.
Right. Okay, let's shift gears now to the more specialized segments. B2B, highly technical stuff, often flies under the radar, but the margins can be incredible. Aviation, for instance, is just soaring.
Yeah, that segment grew 18%, $240 million.
Yeah.
And look at that gross margin, 75%. Wow. They really dominate that sophisticated avionics space, especially retrofitting old planes.
And the key there is just technological leadership. The sources pointed out two huge wins. First, that new retrofit integrated cockpit system for the Cessna Citation CJ-1 jet, but the one that really jumps out, adding auto land and auto throttle to the King Air 350.
That Autoland is a massive safety feature, isn't it? And the source mentioned the King Air 350 is the largest and most complex plane to get it so far. That shows more than just product updates. That's like B2B infrastructure level stuff, plus navigating all the regulations.
For sure. And their confidence shows in the guidance. Full-year growth estimate for aviation raised to 10%. Now, sticking with specialized, high margin, let's look at marine.
Marine looks equally strong, up 20% to $267 million. They seem to absolutely own the fishing and boating tech market through, focused innovation again.
Yeah, they launched the Force Current. That's apparently the industry's first hands-free kayak propulsion system. Total convenience thing for serious kayakers, I imagine.
Interesting.
And they expanded their high-end trolling motor line, too, the Force Kraken. New longer 110-inch shaft model specifically for bigger fishing boats.
And the awards keep coming, right?
Yeah.
National Marine Electronics Association, Manufacturer of the Year, for the 11th year in a row.
Really?
That's just market dominance, plain and simple.
It really is. And it's paying off. Marine full-year revenue growth estimate also raised to 10%.
Okay, so that leaves the one segment that stumbled a bit this quarter, auto OEM. Revenue down 2% to $165 million. And an operating loss of $17 million. What happened there?
Yeah, this looks like purely a financial blip related to product quality from a previous period, that operating loss. It was tied directly to an increase in accrued warranty costs, basically money they had to set aside now to cover potential future repairs or replacements for stuff they sold before. That hit the gross margin hard, yeah, down to 15%.
Ah, okay. So it's not about weak sales now, it's cleaning up something from the past.
Exactly. Management was clear, it was an isolated thing, it's been addressed, and the underlying business relationship seems solid. They shipped their 3 millionth BMW domain controller this quarter, still a critical Tier 1 supplier for high-end cars.
And the outlook there is still positive, expecting 8% growth for the full year, plus a new big OEM program kicking off late 2026.
That's the plan. So, if we step back, take the whole picture, the big takeaway has to be how well that diversification strategy works. It's like a shock absorber. You had that isolated warranty issue in auto OEM, you had the tough comparison quarter in outdoor, but the amazing strength in fitness, aviation, and marine just powered through, delivered record revenue overall, raised EPS outlook.
That portfolio effect is really powerful. And the core driver seems pretty clear. It's that focused innovation, right? Targeting specific, high-value customers, whether it's micro-LED for extreme athletes or Autoland for complex jets.
And we should probably underscore the future potential in those new user numbers, too. They mentioned the convincing majority of registrations are brand new users, so they're actually growing the customer base, not just getting existing users to upgrade. That's key.
Right. But all this innovation, Autoland, micro-LED, the clinical research that costs money, serious investment. And that kind of brings us to the final tension point, maybe hidden in this report. They're forecasting gross margin to dip in Q4 because of holiday promotions. They need those sales.
Right, but at the same time, operating expenses, R&D, SG&A, they're actually increasing, mostly due to higher personnel costs, hiring more talent. R&D expenses alone jumped $37 million in Q3, mostly for people, engineers, technical staff.
So that's the tightrope walk, isn't it? They're banking on those people, that increased R&D spend to create the next big thing, the next Phoenix Pro, the next Autoland, 3 years from now.
Exactly. But they still have to hit seasonal revenue targets now, often using those short-term holiday discounts that squeeze margins. So the question maybe for you, the listener, to think about is this. How effectively can a company like Garmin keep managing these rising long-term R&D costs, which are essential, right, for their edge in aviation fitness, while also relying on those short-term margin-eating promotions just to hit seasonal sales numbers? That constant balancing act between today's sales goals and tomorrow's critical investments, that's really key to watch for long-term success.
Yeah, it's that fundamental tension. Today's margins versus tomorrow's tech, definitely something we'll be keeping a close eye on, those R&D investments, what comes out of them.